Hi everyone, welcome to the Options for Profit Stock Signals video. This video is going to be talking about a new offer that we are providing with the Options for Profit strategy in stocks. Of course, many of you already know that for many years we have provided options for profits in signals for commodities. And I'm going to give you a little bit of context if you're not aware of the Options for Profits commodities, because it is new in stocks, the signals anyway. But in commodities, since inception, the Options for Profit signals on commodities have produced an actual trade track record of 255 trades, 239 of those winners, and only 15 losers. That's a 94% winning track record with actual trades. It has produced winning streaks as big as 52 trades, 42 trades, which is the current winning streak that we are in and have been in since July of last year, 41 trades, 32 trades, 24 trades, and 15 trades. Now, there are many success stories with Options for Profits, including one client who turned a $50,000 account into almost $450,000, trading the OFP signals during a 3-year span and applying money management strategy to that, which I will also discuss later in this video. I also get a lot of emails from clients who are trading the OFP signals all the time. For example, one longtime client from Australia recently wrote, "Your option signals are, as always, cruising along quite nicely." And the reason is because we experience those long winning streaks that I mentioned previously. Now, the Options for Profit signals for commodities filled up last month, as I only allow a limited number of subscribers. However, in February, due to continued requests, I began offering the same strategy-based signals in stocks. Now, since it is the same exact strategy in stocks, we should see very similar results in the stock signals as we have seen in the commodity signals from the standpoint of large winning streaks. And in fact, we have seen that even as we started in early February. We've already seen 11 winning trades in a row, and these are actual trades. So I do expect that we will see similar winning streaks in stocks as we have seen in commodities. So how do we duplicate these kind of almost unheard of winning streaks? Well, take a look at one of the stock trades we recently took. I think this will be a very good example of what we're looking for. On February 5th, we sold a JCP 14 strike put for 30 cents, and that was in the based on the March 15th expiration. We exited that put on February 25th at 5 cents, yielding a 25-cent profit, or $25 per option profit in just 25 days. Now, you might say, big deal, $25. Well, there's a little bit more to it than that. First of all, margin to place this trade was approximately $256. That means that the trade made just under 10% on required capital in 20 days if you have a margin account. If you don't have a margin account, then that's a different story. But nonetheless, if you have a margin account, that's a 10% return in 20 days on the margin required. And you can see here, this is an order confirmation box from Interactive Brokers. Selling the 14 put and the initial margin would be $256 with that particular option. But the real strength in this trade was how much the stock would have had to move against us just to reach break even. So on February 5th, the day we were filled, JCP closed at 1981. Now remember, we sold a 14 strike put. So our break-even level was $13.70. We sold it for 30 cents, which means that the market would have to move down to $13.70 just to reach our break-even. So as long as the stock did not move down $6.11 in the next 35 days, or approximately 31% in the next 35 days, I would make money. That's how the odds are stacked in our favor so heavily, and that's how we can produce some extremely large winning streaks, because we will make money most of the time just simply because the market does not move in such large degrees in such short periods of time. Or take, for example, selling a GMCR 60 call for 75 cents when the market is trading at around 45. So the market will have to have moved higher by 35% just to reach our break-even level. And we were able to exit that trade in just a few days, and the margin requirement was $456, meaning that we pocketed basically a 16% return on margin in less than a week. And we've even had some trades where the market could have moved almost 50% before it hits our break-even. And that would have had to happen in less than a month. So these types of trades happen all the time, and sometimes the stock will move enough to actually hit our break-even level, and then sometimes, although rarely, we will actually take a loss. But the key is diversification and proper money management and trade management. So I want to give you some examples. So below is a recent example of put options order signals. They're very straightforward, and each order provides the return based on the value of the stock, not margin. So if you don't have a margin account, you're talking about the return here. If you look in this column, a 2.27% return without using margin. If you're using margin, obviously that's going to be much bigger, probably somewhere around 20% return based on margin. And I don't recommend that you trade according to margin. I'll get into that a little bit later. You can trade bigger than the minimum, though. You can see that most of the opportunities in these signals provide around a 2% return in that period of time. That's not annualized. It's a much bigger return if we annualize it. So it's around a static 2% return in each market. And you'll also notice that most of these have to move up more than 30% just to reach our break-even level. Now, in these signals alone, just these signals, the total premium, potential premium that can be brought in is $1.80, and that's without margin. So without margin, it would only require $9,000 to take all of these trades and basically generate a 2% return potentially in less than 1 month, and that would be an annualized return without margin of 24%. Okay, so again, that's without using any margin. You're talking about a very solid potential return based on a fairly small amount of money to generate that return. And remember, this is just 1 day of put option signals. Signals come out every Wednesday and Friday after the close, so you do not have to watch the markets for these signals. You can place them before the market opens, after the market closes, whatever, and then leave. Go work, go play, whatever it is that you want to do. There's no market watching required. So I also provide call signals for those who are willing to trade call options. And I realize that not everybody can and not everybody is willing to trade call options. That's fine. There are more than enough put signals during the month to generate a solid return. But nonetheless, during the month of February, we produced over $600 in closed profits based on just one single option per signal for both puts and calls. The return based on margin was over 20% in 1 month. And again, I do not suggest trading or determining your trade size based on margin. I'll discuss that here in a minute. Now, the trade size below, as you can see, is based on the size. And you can round down. There's a calculation here that's used to determine the size or the money management size or the trade size. So on a 5.6, you would trade 5 options. And a 6.7, you would trade 6 options, et cetera, et cetera. Now, how is this determined? Well, this is determined based on a $25,000 account willing to risk 20% in a disaster situation. So you're trading a $25,000 account. If a disaster in one of these trades occurs, then you're risking basically 20% of the account. So for example, in this $25,000 account, I would place 5 options in the SRPT put options, bringing in a total of $200. The price, this is the first one here, the price is at 40 cents. That's the premium that we would bring in, and we would trade 5 options, so that would total $2 in premium being brought in. Now at the time, SRPT is trading at 28. So for me to lose 20% of my account on this trade, SRPT would have to drop to $9. Remember, it's trading at $28. Our strike is at $18. So what it has to do is it would have to drop 68% in order for us to incur an absolute disaster on this particular trade and drop our account by 20%. That's what the money management size is based on, is an absolute disaster of seeing the market move 50% past our strike price. Not 50%, but 50% past our strike price, which in this scenario comes to a 68% move. That's what it has to do in order for us to realize an absolute disaster. And of course, this is assuming that we would hold on to the option all the way down to $9, which of course we would not if we had the chance to get out. Now, I do want to caution you and state right up front that a 68% move is highly, highly unlikely. And that's pretty close to what most of these markets have to move in order for us to actually realize that kind of a loss. It's not probable. It's very, very improbable, but it is not impossible. So you should always address risk first and foremost, because it only takes one time for a disaster trade to occur, you not be prepared for it, and you could be in serious trouble. You absolutely want to prepare for the once-in-a-lifetime type disaster situation that could occur, and this is how you do it. So risk should always be addressed first. That's what we do with this money management size. You know your own financial situation more than me and more than everybody else, so you know whether you have the ability to risk a little more, be a little more aggressive, or whether you should be a little more conservative. If you're trading a $5,000 account, for example, the same applies, only you would divide that by 5. So instead of trading 5 on SRPT, if you only had a $5,000 account, you would trade 1. And then you would be risking, in an absolute disaster situation, 20% of that $5,000. So that kind of gives you a benchmark of, okay, is that too aggressive? Is that right where I should be? Or is that too conservative? I can definitely risk more. That's up to you, but that kind of gives you a benchmark. So you address the risk first, but you address the you address the profit through compounding, not through your initial trade size. You compound based on success, based on profits. So we will discuss that in the next slide. Now, if a trade begins to approach our break-even level, so many of these, the market has to move 30, 35, 40%, sometimes even 50% just to hit our break-even level. If it begins to move towards our break-even level and threatens to hit our break-even level, we will try to mitigate the loss potential. We do not use stops. If you have taken my Options for Profits course, you will understand that stops, and I say this with all due respect, stops are the stupidest exit you can possibly use when you sell options. And I tell you exactly why that's the case in the Options for Profits course. And it's just something that we don't use. I have never used stops in trading options and have never once regretted not doing so. I'm willing to take the loss when the market actually moves into the money or very close to into the money. And otherwise, it's all extrinsic value. So there's no reason. We profit from people panicking. We don't want to be part of the people that panic. And people that use stops when they sell options are people who panic. So just to give you a quick soapbox, if you will, on that. However, we do implement strategies to try and mitigate that loss, but we are always willing, if we absolutely have to take that big loser every now and again. Again, doesn't happen often, and I will put that into perspective in a minute. However, when an option approaches our strike, we give exact exit orders to help mitigate the loss, and I fully explain what those orders do and why we're using them. So there is a bit of teaching process when we start to when one of our trades is threatening a loss. As I suggested earlier, everyone is different in how aggressive or conservative they are with trade size. Again, if you want to trade a smaller account size using the same benchmark, you can do so with 1/5 of the trade size in the MM size column. Now, let's talk a little bit about profit potential. We average about $250 profit per trade. Some will be less, some will be greater. For example, the SRPT, based on 5 lots, and the price that we brought in would bring in $200. So there are some trades where the profit potential is smaller, and then there are some trades where the profit potential is larger. But the average is going to be about $250 profit per trade. If we close an average of approximately 10 trades per month, that means that we're going to see potentially a return of 7 to 10% monthly based on the MM size and a $25,000 account. And if you trade a smaller account, like a $5,000 account, and you trade 1/5 of the MM size, you're still looking at a 7 to 10% monthly return on average, and that's inclusive of the occasional smaller loss. However, the potential is there for us to suffer that disaster trade. But because of the diversification and the number of trades that are available and the amount that we're bringing in there, and because of the probability of success, we can suffer a disaster trade once every 2 months and still break even, or come very close to break even, or maybe even do a little bit better than break even. So that's where the profit potential comes in. Even though there is that risk of a disaster trade, it is extremely unlikely that we will see that once every 2 months. But even if we do, based on all of the other trades that we're taking, the probabilities of those trades, we should be able to, even with that occurring, at least break even. So that gives you a very, very high probability of long-term success, even hitting the occasional disaster trade. Now let's talk about the compounding. For those that get involved with the Options for Profit stock signals, I'm going to have a video, or a webinar actually, that you can attend live. It's March 11th. You can attend that webinar live. It's going to be about an hour, and I'm going to explain the compounding strategy. And based on starting with the MM size and starting with a $25,000 account, using that money management strategy, or the compounding strategy that I'm going to reveal in the video, and I'm also going to provide you a spreadsheet, you can turn a $25,000 account into $80,000 after year 1. After year 2, that $80,000 turns into $209,000. After year 3, it turns into $410,000. After year 4, it turns into $683,000. After year 5, it turns into $1.028 million. That's starting with $25,000. That's a 5-year plan, and that's assuming that we average about 7 to 10% profit per month. So there, occasionally we will do better than that, and occasionally we'll suffer a loss and we won't meet that goal. So it's based on an average out over the 5 years. Now, at the end of the 5 years, and this is what most people don't realize, is that you can actually geometrically grow your account while decreasing your overall risk. Now, remember, at $25,000, we're risking 20% on a disaster trade. Well, once we hit $1 million, your risk is only 6.2% on a disaster trade, not 20%, 6.2%. So you are geometrically growing your account while you're also dropping your risk by almost 300% on a disaster trade basis. Now, in comparison, if you don't compound, at the end of 5 years, the $25,000 turns into only $172,000 based on the MM size that we give in the signals. So compounding absolutely is very, very important. That's where you address the profit potential. You don't address the profit potential at the beginning with your starting trade size. You address the risk first at the beginning with your initial trade size. You let the money management strategy compound your returns as success comes, and you'll find that that actually drops your overall risk at that level as well. Now, if you only start with $5,000 and you do the same thing, you have very, very similar returns. 5,000 turns into 38,000 after year 1. 38,000 turns into 143,000 after year 2. And then into 320,000 after year 3. 568,000 after year 4, and 890,000 after year 5. And again, that's starting with 1/5 of the MM size given in the signals, and then applying the compounding strategy that I provide in this live webinar and in the spreadsheet. And if you're unable to attend the live webinar, it will be recorded, so you'll be able to access the recording, and you'll be able to access it as many times as you want. So again, compounding, no matter what trade size you are, you definitely want to implement a compounding. Again, at the end of this, your maximum risk on a disaster trade occurring is 6.7%, not 20%. So you see the same effect. Now, if you don't compound, at the end of 5 years, your $5,000 turns into $34,000. So just by compounding, you increase in 1 year more than what you would increase in 5 years by not compounding. Vitally important. This is why I focus on money management my entire career. So just a little bit of a recap. Signals for the stocks are at the end of the day, twice weekly, after Wednesday and Friday on the close. All fills reported are actual trades. I take every single trade, bar none. We do provide puts and calls. Even if you don't want to trade calls, we still provide the signals. We're not going to divide those. The exits are fully explained, especially when we begin to suffer a trade that's threatening a loss. We fully explain the exits or the strategies that we try and implement to mitigate the potential loss. And then the trade size is fully explained in that webinar. And I've already halfway explained it in this video. Now, obviously, as in the options for profits commodities, the subscription to the stock signals is absolutely limited. I expect it to fill up within the next 30 days, and I expect the first discount to fill up within a week or two, and I'll explain that here in a second. With your subscription, you get 1 year of the signals, exact entry and exit rules. You get the trade size compounding spreadsheet, and you get the 1 hour live class explaining the compounding. That's with a year subscription. And by the way, there is the link. That link is also in the email that you received when you had notification of this video. So there's the link to take advantage of this particular special. The first 100 sign up for only $497. Once that 100 is done, it goes up to $597. So with that $497, you get everything that I just mentioned, and it basically comes out to $41 a month. And you can make that back with one trade a month, literally. All it takes is one trade, one option a month to pay for this thing. So even if you're not fully prepared to go into it gangbusters, you can still pick and choose maybe 1 or 2 trades per month, and you can more than pay for it as you learn. And then when you're ready, you'll have already gotten the lower price, and then you can begin to increase as you want. So after the first 100, the price goes up accordingly. The next 50 goes to $597, the following 50 goes to $697, and then the final 50, so I'm limiting it to 250 subscribers, it's $797 a year. If you're not ready to commit, the price is $77 a month through March 15th, or through the first 100, and then it goes to $97 a month until the subscription is full. I will state that the compounding material does not come with a 1-month subscription. You would have to pay extra if you just want to go monthly. You would have to pay extra for the bonus webinar and compounding strategy. Now, there are no refunds. Once you subscribe, even on the month, any partial of 1 month is a full month. And I want to make this very clear. This is a very limited opportunity. This strategy has been proven over and over and over and over. Yes, there are risks. No, there are no guarantees. But I'm just not going to provide refunds for this product. Refunds are for products where there's no limitations or where people are trying it out, or for something where maybe there's extra risk and it's not really proven. This is proven. Either you understand it or you don't. Either you see the opportunity or you don't. I'm not giving this to tire kickers. So if you think you even might want a refund, don't even bother getting involved. I just want to make that very, very clear. So if you're uncertain about whether you want to commit, then subscribe to the monthly rate. And as long as you remain a subscriber, you will secure that spot and that price. Okay, so the probabilities in this are fixed in your favor. A loss, even several losses, does not negate the future probability of success with this strategy. So drawdowns do not constitute a reason for a refund. This is not performance-based. We know what the probabilities are. If they don't happen, they don't happen. Each individual trade carries a 94 to 96% probability of success, regardless of every other trade. A 1-year subscription can be paid for literally within the first few trades, especially if you're using the money management size suggestions. So what does it take to take all of the trades? Well, since each individual signal has an independently high probability of success, you can pick and choose. A $5,000 account can take between 5 and 10 trades per month comfortably, trading 1/5 of the suggested money management table, and you should see between 3 to 10%, depending on how many closed trades you take. If you only take 5 trades, closed out trades, you're looking at about a 3%, maybe a 5% return on a monthly basis. If you take if you close out 10 trades, you're looking at closer to 7 to 10%. Now remember, the money management table is based on a $25,000 account. So if you trade a smaller account, you want to decrease the trade size accordingly. As long as you do that, the average profit expectation, it remains the same at about between 7 and 10% per month, and that's without compounding. Now, if you are a more conservative trader, again, or you do not have a lot of experience selling options, especially calls, I strongly suggest you start out smaller until you're comfortable with the strategy, until you're comfortable with your understanding of what we're doing, and then you can always apply the compounding strategy. So I hope that answers most of your questions about the stock signals. Again, the first 100 subscribers, $497. That's not a month, that's a year. I apologize for that typo. Nonetheless, that is for a year. You'll see that on this page. It says a year. It'll probably be done within the first 2 weeks. If you're late coming into this video, I apologize. You may already be too late in getting in the top 100. It will tell you on this page. Once we hit the 100, we will change it on this page, and you'll be notified. So you're not going to pay. If you don't want to pay $597 for the year, you're not going to be surprised. It will clearly tell you our first 100 is done. You now have to pay an extra $100 or whatever the price is based on where we are in that subscription level. Okay. Once we hit the level, we'll cut it off and we're done. And I expect that probably to be done within 30 days. Again, thank you for attending this video. If you have any questions, you can contact our support by email or live chat. And I look forward to seeing you on the live call March 11th. You will receive more details as we get closer to March 11th through email after you register. Everyone have a great day.